All right, I will think we'll get started here. Thank you as always, folks, for taking some time out of your day to join us. Second quarter is already behind us, hard to believe. And here we are well into the third quarter. And of course, the excitement continues. We're seeing a pretty good market run up in June and in most of July so far. And I'm going to touch on this later, but we really only saw a run up in January. And then we saw pretty much a lack of momentum, even some negatives going into February, and then some improvement. But the real improvement came in June and into July, which puts all of us in a pretty good mood, I think, versus last year. We're all pleased to see a year like last year being behind us. I always do a lot of research on what's going on in the markets, and I really love the research and learning and getting the thoughts and opinions on analysts out there. And it really never ceases to amaze me how many predictions are out there at any given time, and how few of those predictions are remembered when they're no longer true or when they're no longer accurate. And that's why I decided to title this one "Trusting What You Read." And a lot of times people bring to me an article, or they'll send me an article, or they'll make comment about an article or a commentator and what the expectations are or the thoughts are of that commentator. And to be honest with you, as much as I enjoy hearing and discussing that, it's all just noise, because nobody knows what's going to happen. Nobody knows, even close to what's really going to happen. Otherwise, there would be a tremendous amount of success out there for somebody, or for a few fortunate people who were able to make those predictions. This is a summary of some pieces that I saved at the end of 2022 that are exactly that. A lot of the commentators and a lot of the industry believed that 2023 was going to be the year of the bond, right? Nobody's going to do better than investing in bonds. Bonds will be by far the best performing. And, so the start of 2023 really had many people thinking that the bond environment would be one to capitalize on, with the expectation that we'd see a significant rebound occur after the worst bond market in history. Yes, the worst bond market in history in 2022. And as a result, of course, when bonds go down in value, we see yields go up. So at the same time, being the worst bond market in history, we saw an absolutely incredible increase in bond yields, making them pretty attractive. Now, bonds did start the year incredibly well, with an out-of-the-gate performance almost as strong as equities in January. But as the months dragged on, bonds actually softened a bit, and equities fluctuated back and forth. February of 2023, the S&P 500 was down about 2.5%, but it did rebound in March with a pretty solid 3.5% result. April brought us another return of about 1.46%, and May was relatively silent with about 0.25% return. But then came June, when equities took a fierce jump forward. As a matter of fact, the S&P 500 mounted an incredible 6.47% run that has continued so far into July. Bonds themselves mounted a pretty incredible 3.5% start to the first month of the year. But the US Aggregate Bond Index has done pretty much nothing since, actually shaving about 1% since their peak in January. Similar to what we read back in December and January about bonds, we just can't believe all the things that we read about equities either. When you do take a look at real total return, which is the rate of return minus inflation, the only asset class that has presented a positive result so far this year are equity stocks. As a constant student of everything investments, I actually find it very hard to get my arms around the enthusiasm for an asset class that is incredibly overpriced in domestic markets. I often use the analogy of the stock market being no different than our favorite store. So when you take a drive down the street and you're passing by your favorite store, and they have a sign out front that announces that everything's overpriced, come on in and fill your shopping cart, I think the majority of us on this call would drive right by unless the store was offering something like a necessity, like food or something like that. But similarly, if we were to drive by and the sign out front read that we have our lowest prices, adjusted prices since 2014, most of us wouldn't hesitate. We'd be inclined to stop by, take a look, maybe fill up a grocery cart or two, pay for it, and leave with a really good smile on our face. But the stock market is a very different type of store. It's one that people tend to get excited about when prices are really high. And that's what leads us to the constant bubbling that occurs in different parts of the market. It's also, of course, what leads us to most people not performing very well because they get excited and invest when things are good. And of course, they get nervous and scared and take money out when things aren't good, which is the opposite of what we want to do when we're investing. Obviously, we want to buy low and sell high. But if you think through what I just explained, when people are buying high and selling low, of course, they don't end up in such good shape. Now, if you recall, last quarter, I spent quite a bit of time talking about the attractiveness of international and emerging market stocks versus US stocks. The news on international and emerging market stocks has actually been quite quiet. However, as of the end of the week before last, the international index has had a very strong year to date, up about 15.19%, and emerging markets a pretty respectable 9.65% return. As most of you know, two of our core positions were on the watch list last year, and that was really as a result of their underperformance versus their peer group. But we did the difficult thing, and we held on to those positions as we believed in the managers and of those two funds, and the conference calls were consistently meeting or exceeding the expectations we had of what we expected of those managers. I'm pleased to say that both of those funds have strongly outperformed their respective peer groups year to date, and they have been removed from our watch list. I've had the opportunity to discuss these funds with a lot of you, and for those that I have not, I do look forward to discussing those in our next meeting. Now, many have wondered why the substantial and quick increase in interest rates have not done much to slow the economy down. We live in such a different world than we did just a few years ago.
Get you in there.
Be sure to keep yourselves on mute, please. Immediate gratification is now an expectation more than it is a desire, but not all things can happen quickly. The Fed's effort is a great example. Although we want their efforts to come to an end because its impact has so many impacts on because its efforts have so many impacts on our daily lives. It's important to understand that the very thing that caused us such great financial success from 2020 to the end of 2021, and really more accurately from 2009 until 2021, was the incredibly low interest rate environment that we experienced. In combination with the substantial influx of money into the economy, not only through all those years, but especially through COVID, we experienced what may have been a once-in-a-lifetime boom. The Fed was then tasked with slowing things down, but that effort will take some time. This time, perhaps longer than in the past. Now, as we look at these points, we start to see why, but we are also starting to see the impact, as I'll explain in a few moments. So taking a look at these points, the high savings rates in the household sector and the post-COVID strong demand for air transportation, hotels, and restaurants has really helped to extend this market more than we would have expected and helped to stay off recession. Same with the high yield and investment grade corporates. Those are different bonds that exist. US households have 30-year fixed mortgages and therefore are less sensitive to federal hikes. Higher mortgage rates for home buyers are holding back the supply of homes. So we have a very, very different marketplace today than we did 15 years ago during the housing crisis. And a lot of people have extremely low interest rates. As a matter of fact, some studies show that about 60% of people have an interest rate that is less than half of today's interest rates on mortgages. And that's keeping people from putting their homes up for sale and buying new homes. A growing share of CAPEX spending is on intangibles, so companies spending money on software and R&D. And then the IRA and CHIPS Act are creating a boom in the energy transition and manufacturing that we've never seen. Let's talk for a moment about leading indicators. As you can see here, the leading economic index shows pretty significant softening. As a matter of fact, it's the lowest that we've seen since the pandemic and quite similar to what we saw back in the year 2000. An important point to recognize is that the peak in 2020 was quite high as well. That peak for leading economic index was the highest it had been since the early 1980s. Now, I don't know that having such a high peak has any indication of suggesting a lower trough, but I certainly think that it's worth considering. Let's look at the used car market. So the used car market experienced a pretty significant decline in prices at the beginning of the year, but recently prices have started to creep back up in the used car market. This is the case in spite of the substantially increasing interest rates. and it's reflecting the excess capital that families have had on hand as a result of the pandemic. Taking a look at this chart, the interest rate on vehicles is the highest it's been dating back to the late 2007 or early 2008. And over time, this will most likely result in slowing vehicle sales. Credit cards have often been the source of pain for many of us, especially given the high interest rates paid on recurring balances. And it's no secret that interest rates are up strongly from just a year ago. What's shocking is the rates that are the credit card rates are the highest that they've been since the early 1990s. Those who carry credit card debt will be faced with new challenges as they pay well over 20% on average in credit card interest rates. With the increase in interest rates, it's no surprise that banks are experiencing a decrease in lending. Forecasts have the level of lending falling nearly as much as they did post the Great Recession back in 2009 and in 2010, but for very different reasons. The reduction in lending is a strong indicator of slowing growth in the US economy, demonstrating the Fed's efforts are actually working. And if you refer back to the bullet points that I listed a few moments ago as to why it's taking a while for the Fed's impact, that has a lot of impact here as well, because a lot of reasons that we're not seeing the lending is because people did so much lending post-COVID. You can see how high those numbers are in this chart. Retail sales are certainly slowing as recently as last week. The data shows it is slowing even more than what was expected. And we saw a historic climb in retail sales through the pandemic. While there's still a pretty substantial balance left from the COVID funds injected into the economy, it appears that people are quickly shifting away from retail and more towards service. The next year or so will show the impact of the Fed's efforts. More than likely, that will be felt quite strongly in the service sector, as indicated by this chart. And the expectation is that fewer jobs will be created in the service sector. This sector represents those in the maintenance, repairs, training, and consulting industries. And some examples would include teachers, nurses, housekeepers, etc. This most likely indicates more pressure on those industries as we move forward in the business cycle. And as you can note on the right-hand side of this chart, a lot of times the impact of the Fed's interest rate hikes take 12 to 18 months to really experience, to really feel. One more important chart, bankruptcies. So bankruptcies dropped to one of their lowest levels in history post-pandemic. However, they're back with a vengeance as we see the bankruptcy rate actually approaching the levels that we saw in the heat of the pandemic, but otherwise not since 2009. And I do suspect that this number will continue to climb and potentially exceed the 2009 level as the Fed's interest rate increases carry us into 2024. Even still, many are predicting that we may not experience a recession. Even the likes of Jerome Powell made this statement back in late June, that a recession is not the most likely case. Now, I did watch this presentation, and he did not state what the most likely case might be, as many of us are probably wondering, but I suspect that there's a concern for deflation or stagflation that could be on their minds. Confusion abound, even with Powell's comments, the consensus is still high for a US recession. It's actually much higher than the expectations for a recession for our neighbors to the north in Canada. Higher as well than the expectations in both Europe and the United Kingdom. As all things, time will tell, and this makes it clear that nobody really knows what's going to happen. The bottom line is that monetary policy is actually working exactly the way that it should, with higher interest rates leading to slower growth. As I alluded to, the spectrum of opinions on recession continues as we see those who believe in a very deep recession being imminent and others who feel that we may not even see a recession. I happen to be in the camp of the recession being a shallow recession. There are concerns starting to mount as we see bankruptcies increasing, credit card debt mounting, and defaults on auto loans increasing. However, we still have a very strong labor market as well as wage growth, helping to protect what may otherwise be a deep recession from occurring. As you can see from this analysis, real personal income continues to be strong, as does non-farm payroll employment. However, softening are consumer spending, as noted just the other day with retail sales down more than expected, and industrial production. These are certainly reflective of the Fed's rate increases to slow down the economy taking hold. So if you just take a look, you can see this is a heat map. All the way over to the right-hand side here is May, the most recent readings. And here you can see at the top, real personal income less transfers is improving as it goes from a concerning color to a less concerning color. Non-farm payrolls have stayed about the same. A little bit of weakness in household survey employment, a little bit of weakness in real consumer spending, not yet reported are wholesale sales and retail sales, although this information came out last week, and we did see a greater than expected decrease there. So that's worsening. And then a worsening on industrial production. Internationally, it's much of the same. Nearly every country and major city has experienced a decrease in GDP growth. Hong Kong had a very different situation in 2022 than the rest of the planet as a result of their lingering response to COVID. And a few countries are experiencing year-over-year increases in GDP, namely India and Mexico. India has experienced a strong increase in foreign investment as well as a result of reduced crude oil prices. And Mexico has experienced an increase in tourism as well as exports, leaving those countries to pretty strong results. Now, what goes up must come down, or at least that is the case when it comes to inflation. Only a few countries have experienced higher inflation versus a year ago. Domestically, we've seen a really nice inflation fall to 3% in the year over year for June of this year. And you can see, of course, the majority, as outlined here, of countries are experiencing nice decreases in inflation. The US federal funds rate increased again in May, but has since slowed, keeping the central bank rate in the 5% range. Other countries have followed suit, with their most recent action being an increase in rates as well. And we are certainly seeing the global monetary tightening occur. China is the only country that has seen a reduction in rates in 2023. You can see that here, the cut in 2023. Japan, although their last move was a cut, that was in 2016, and then Russia's was in 2022. All the rest this year, a couple of them in 22, have experienced hikes, increases in rates. The true-flation reading has us at an attractive 2.11%, while the most recent Fed reading was 3%. This is a pretty substantial decrease from the 11+% reading we had a year ago. True-flation, by the way, is an independent and non-biased inflation index with the goal of providing the most objective and decentralized inflation reading. True-flation itself estimates that its readings are about 30 times more accurate than that of the official numbers. I'll leave you to be the judge if you wish to research true-flation further. But again, good news, by all accounts, inflation is significantly decreasing. Now, the news on inflation coming down is a sign of relief as consumers look to continue to spend the resources they built up during COVID. I've alluded to this a couple of times today, but the excess savings during COVID was estimated to be a total of 2.3 trillion, and the estimated excess is still about 50% of that, with about $1.2 trillion still sitting on the sidelines being waiting to be spent. That means that the chances are strong that the American consumer will stay strong for the foreseeable future. Whether they'll consume services or goods is the question. One last consideration when it comes to the potential of a recession, and then we'll turn our thoughts back to investing. The last 3 times that the ISM manufacturing was this low, the US economy was in or about to be in a recession. You have to go all the way back to 1995 or 96 to find a lower reading with no recession. The chances of a recession are still quite strong, but I'll stick to my own opinion that if we do experience a recession, it should prove to be a rather shallow one as a result of the unemployment numbers, wage growth, and the slide we just saw with regards to excess savings on hand. All right, let's turn to the markets. The climb in the S&P 500's price to earnings ratio has continued this quarter from 19.1 to 19.1 from 17.8 last quarter. Here we are sitting at 19.1, and here you can see the 25-year average has been 16.79. So we are well over the 25-year average. As I noted last quarter, that simply means that US stocks, as measured by the S&P 500, are by no means considered cheap versus the price value the last 25 years. Think about the example of your favorite store I gave a few moments ago. Dividend yields are also down from 1.74 to 1.59, and you can see that number here, the 1.59. And the price to cash flow is up by 1.5. We cannot make a decision based on this analysis alone, which is why we have not and will not sell out of the US markets entirely. Taken from my comments in our last quarterly discussion, although we wish we did back in the early 2000s when we saw somewhat similar market conditions, the decision to sell really requires two nearly impossible decisions: when to sell and when to get back in. Although we are confident in our abilities as money managers, we have no confidence in our ability or the ability of others to make those two impossible decisions. Last year was the great shift from growth to value, and many, including myself, fully expected this shift to continue as the growth environment was still quite overpriced. To our surprise, we saw a substantial shift in January and again in June, going from value back to growth. Over time, the markets tended to shift back and forth, balancing one another out from a valuation standpoint. And what we see is that value is very reasonably priced versus its long-term average, while growth as a whole is about 35% overpriced. Dating back to late 2017, value has been a better bargain than growth. That does not always mean that money will quickly shift to the better bargain, as you may recall. The market is a voting machine in the short run, but a weighing machine in the long run. In the short term, investors vote on which stocks are the best, but in the long term, companies with strong fundamentals tend to prevail. And just to make sure we make this chart clear, the line here represents if the chart is above, that means that growth stocks are cheap. And if the line is below, that means that value stocks are cheap. And you can see pretty clearly here, going back to 2017, value has been a pretty good value, if you will, but it's been on the inexpensive side with growth on the expensive side. Here's a closer look at the numbers. The top center, if we look here, the performance of US growth and value. So here are large value, large growth. Look at the difference in these. So far, year to date, value is only up about 5.1%, and large cap growth about 29%, which some of you may recall is exactly what it was negative by last year. And by the way, the same for value, it's up about what it was down last year. As we slide over to the right-hand side, we start to see the valuations, with large growth being about 44% higher. See this number here, 144% of the 20-year average price to earnings ratio. And small value is about 89% or discounted by 11%. So a really big difference in domestic equities when you go from large cap growth to small cap value. And then of course you can see the numbers here on small cap growth being about 60% overvalued. This comes back to the comment of the short term in the markets being a voting machine and the long term being a weighing machine. Over time, investors gravitate towards companies that are well run, profitable, and producing a reasonable amount of revenue versus their price in the market. If you own a business and you're able to sell it at a multiple of 27 times earnings, I don't think you would hesitate for a moment to sell your business. More realistically, most business owners sell their business for between 8 and 12 times earnings, which helps to bring home the point here that these companies are selling at a pretty significant multiple. Again, emphasizing the overvaluation of the US markets, with large cap growth being at about 27 times earnings. Here's that number right here, 27 times earnings versus the 20-year average about 18.7. Now, what a difference a year makes. Let's take a look at the various sectors of the S&P 500. Here's your 2022 full year and your year-to-date 2023 as of June 30, so halfway through the year. And if you take a close look here, you can see financials for the year. I'd like to look at the green because that's the year. This is a slide from JP Morgan. I had to include the 1 weeks as well, but I want to focus on the bottom half of this, which is the full year versus the year to date. So you can see here, energy was up 65% last year. If, like a lot of investors, you were to chase returns and invest in what did the best, you would be pretty disappointed. Look at energy, negative 9.9% year to date. On the flip side, take a look at technology, negative 28, and communication services down 40%. And here you see our best performers. Technology is up 38, communication services up 35. Very interesting. So again, 2022 was obviously an incredible year for energy, but for virtually every other asset class, a year that we would really like to forget. This year, the markets have done a complete reversal, with energy being the worst performing and technology and communication services being the strongest performers. Wouldn't you know that there was an increase in the amount of money deposited to energy investments as people follow the returns? Now, we came to know the term FOMO, F-O-M-O, in 2020, meaning the fear of missing out. FOMO is a very dangerous and contagious thing, and that one that we aim to avoid in our efforts on your behalf. We will not seek out the best performing sectors or asset classes on your behalf. We'll aim to maintain a well-diversified portfolio with occasional overweights in areas that appear opportunistic. Chasing returns, as these charts indicate, are exactly the reason that we avoid such behavior. In terms of asset class results, for the year to date, we are seeing quite a reverse from last year for the most part. REITs are still not a strong position considering their dismal performance last year, and we have fortunately retained a very small exposure here. However, check out commodities, having followed last year's results with a very soft start, while US large caps have rebounded from their 18% loss last year to a sound 15.5% year-to-date result. Commodities, again, negative 8.9, really the only positive performing asset class last year other than cash. And here you see, again, REITs being quite soft last year and only a very, very mild improvement year-to-date, 2.6. Now, companies in the S&P 500 that don't pay a dividend were actually up 18% in the first half of the year versus a 4% gain for dividend payers. That's the biggest underperformance in dividend stocks since 2009. Last year was quite the reverse, with dividend stocks being the strongest outperformance since the early 2000s. We continue to keep a pretty good mix of dividend and non-dividend paying stocks in your portfolio, but this chart demonstrates quite well why we do not substantially overweight to one versus the other. Short-term instruments, such as money markets, continue to thrive in the current interest rate environment. Banks, however, have not caught up and continue to reward their customers with very low yields versus what is available in the marketplace. If you have a substantial balance in the bank, it may very well be worth considering a money market, as yields in many cases are substantially better, often by 10 times or even more versus what the banks are paying. And I think this is a really neat piece to look at, because here you are 1 month on the yield curve, 3 months, 6 months, and then it starts to trickle down as you go longer on the yield curve. Some of you may be interpreting this properly. This is still an inverted yield curve, right? And you can visualize that inverted yield curve. Traditionally, a yield curve looks something like this. You get less in shorter time periods, and it goes out like this. You get more in later, longer time periods. I'm not sure any of us would have guessed this, but as of the first 134 trading days, the S&P 500 is actually in the top 12 best performances ever. I'm really curious to see what the rest of the year brings. One thing the second half of the year will bring is either a new lease or a new location for your team here at CWM. Our lease expires in October, and we are in the midst of negotiating that lease with a landlord that seems to not understand the challenges faced by commercial real estate in today's market. If only we could consider a move away from the New York tax brackets, as many people have. Take a look at this. So this is just a kind of off the cuff slide that I want to include, but I couldn't help sharing this piece when I came across it when I was doing my research for this commentary. Take a look on the right-hand side. The outflows from California and New York and Illinois are just incredible. And no surprise, the rush is to the warm and tax-friendly states, and that rush has skyrocketed for the folks in Florida and Texas. And several of you have properties or even are in Florida right now, and you have seen that change in the traffic, housing prices, the supermarket lines, etc. But this piece really hit home for me in demonstrating how many people left the states of California, New York, and even Illinois outside of international migration. Right? And look at, again, Florida, Texas, and even North Carolina, South Carolina, Tennessee, Georgia, and Arizona. And that's where the line pretty clearly stops. But those southeastern states, a little bit of Midwestern South states, but just an incredible influx of population there. It's not just the weather, folks, it's also the taxes. One last thing before we open up for questions and comments. Over the years, we've never made an investment in marketing our practice. A couple of years ago, as many of you know, we did discontinue taking on new clients. And the good news is that we now have the capacity with the 3 new team members that we've added to expand. And I'm very excited to welcome some new clients. We also made an investment in advertising for the very first time. And I'm excited to take a moment now to share with you the first ever custom wealth management advertisement. Typically, a prospective client of custom wealth management already has an existing financial advisor. And the reason that we've met with them is their good friend, their CPA, their attorney has suggested that they meet with us. We have worked diligently to create a trademark planning process that we refer to as the custom wealth architect. We wanted something that was client-centric. I was just amazed that somebody like this existed in the Syracuse marketplace, because there's nobody I've met that comes close to this type of service. So again, our first ever advertisement. I don't understand all this marketing stuff, but somehow it's going to get pushed out there via mobile devices, very little bit of television, especially on the streaming services like YouTube TV, etc. And I'm really pleased with how that came out. For those of you who know the team well, nothing originally when the marketing group that we engaged put this together, they had a lot of stock stuff in there. And we finally helped them understand why we wanted to get away from stock photography, stock this, stock that, and voiceover. And that's 100% the team that is here working for you. So we're pretty excited to get that out there. And with that, myself and the entire team here at Custom Wealth Management would like to thank you, not just for taking time out of your day to join us, but also for the opportunity to work with you and your family. And with that, I just want to open this up to any questions, any thoughts or comments that anybody has. And we have another roughly 20 minutes to talk about whatever you'd like.
So other than looking more at parking your cash in the outside of your bank account, what are your other perspectives on where you're going in the next 3 to 6 months?
Sure. So international is really looking attractive, increasingly attractive, especially with these valuations. But we'll never completely sell out of the U.S. markets. We will more than likely overweight to international and emerging markets to take advantage of the cheap opportunities that are there. But with international and emerging markets does come a little increased flavor of risk, and we have to be careful for some of our clients to manage that risk carefully. I do have to reemphasize some of the concerns on the domestic side, especially on the growth side of things being so overvalued. And I've had some folks who've commented that it's a different market, John. It's a different environment than it was previously. And this is incredibly familiar to me because a short 24 years ago, I heard the exact same thing from clients. And I even saved some of the articles and pieces that were published then that it was a different market. Warren Buffett lost his touch, et cetera, et cetera. But I still go back to years and years and years ago, Buffett's comment, which I believe came from his mentor, Mr. Graham, and that is that in the short term, the markets are a voting machine. The more votes for high-performing crazy stocks, the more money will go to it, and we'll continue to see results. But in the long term, people will move towards companies that have very strong fundamentals.
As you know, we have an extreme interest in the housing market coming up, both selling and buying. So I think the surprise, as you pointed out, has been that people are kind of handcuffed with low mortgage rates, and where they might have chosen to move, they're choosing not to move. But there are other reasons sometimes people have to move. Do you think the supply is going to increase?
I think we have no choice but for the supply to increase. As a matter of fact, nationwide, the estimated shortage on housing is between 1.2 and 1.5 million single-family homes. I would be concerned if I was an apartment complex holder, right? I think now is a really good time to sell your apartment complex if you own one. And this is just a cycle, right? We've seen these cycles in the past where apartments become really popular, really high rents, really high value, and then you see that cycle dampen out, and then it flips to housing, single family housing, et cetera, et cetera. And that's where we are. But the problem is, and the reason that it's getting extended is because we have a big shortage in housing for 2 reasons. 1, the supply, and 2, people are less likely to move because they got incredible interest rates that are roughly 50% of where interest rates are today. So the opportunity in buying a new home is incredibly reduced because of how few people are putting their existing homes on the market, coupled with the shortage in new housing. I'm really curious to see what ultimately happens. So the question was with regards to inflation, and if we expect inflation to continue to come down. We do expect inflation to continue to come down, and of course, that's really 100% to do with the Fed's efforts in slowing the economy, and their efforts are paying off. We won't know for a year and a half, maybe even 2 years, if the Fed's efforts were overdone, because it does take that long to really feel the impact of their efforts. I do think that we will probably see another rate increase, maybe 2, and then hopefully early next year at the latest, we'll start to see some softening, some rate decreases. And of course, as we start to see rate decreases, we should really start to feel that quickly in terms of impact, both in our spending, in consumer spending and in our portfolios is our hope. By the way, the consensus came out today. We were looking at it this morning, and I couldn't put it in the presentation, but consensus for the end of 2025 is that we end up somewhere in the neighborhood of about a 3% Fed rate. So about a 40% reduction from where we are now. Well, I hope you all enjoy the rest of your summer. It's going to pass us off quickly, sadly. I'm excited to take a week off at the end of August to enjoy some time at our camp. But we look forward to connecting with you all soon. And in the meantime, stay healthy.